Aloha students, and welcome to the lecture on chapter 16, the first of several chapters in Principles of Accounting 2. So what we're trying to do in this chapter, learning objective, is first to define what is managerial accounting and understand how it's used. We're going to look at the differences between service, merchandising, and manufacturing companies. We're going to look at how we classify costs for those service, merchandising, manufacturing companies that we just talked about. We're going to see how we prepare an income statement and a schedule of cost of goods manufactured for a manufacturing company, and then calculate the cost for each item. And for service companies, we're going to calculate what the cost is for providing a service, and also the cost for providing items for a merchandising company. Okay, so first let's look at managerial accounting. So managerial accounting involves planning and controlling. So planning, when developing a plan, managers choose goals, and then they decide how to achieve those goals. So planning obviously is done ahead of time. So setting goals and then trying to determine what is necessary to achieve those goals. Controlling, on the other hand, is during the process of actually implementing those plans and then evaluating the results. So planning is planning for ahead of time. Controlling is actually doing it and then seeing how you did. So one of the processes we'll learn in this course is comparing actual results to the plan. The plan is often called a budget. And we want to see how well we did against the budget. Here's a little chart on the differences between financial accounting and managerial accounting. I believe this chart is in your textbook, so even though it's hard to read here, let me go through it quickly and you can look at the details in your textbook. The primary users of financial accounting is external users, creditors, investors, government authorities, so people outside the company. Managerial accounting, on the other hand, is mainly geared toward internal users, so people within the company, managers and employees. The purpose of financial accounting information is to help investors, people looking to invest money or buy stock in a company, and creditors, people who lend money to the company. It helps them to make decisions about whether to invest and whether to lend money to the company. On the other hand, purpose of managerial accounting is to help managers and employees plan and control operations. So it helps them manage the company. The focus of financial accounting generally focuses on the past. So financial accounting, as you remember from your Accounting 201, is the preparation of financial statements. So the focus is on past performance, seeing how you did financially in the past, whereas managerial accounting, the focus is primarily on future decisions. So using information to plan for and plan for the future. Rules for financial accounting, companies are required to follow a specific set of rules called GAAP, Generally Accepted Accounting Principles. These rules are developed by accountants, basically, and all, especially publicly traded companies, but almost all other companies have to follow those rules in preparing financial statements, again, to provide for a comparable set of financial statements so that everybody they follow the same rules, so that you know the statements can be compared to each other since they're all following the same rules. Managerial accounting, there basically are no rules. It's whatever the management of the company, whatever information they need in whatever form they want. That's how managerial accounting reports are prepared. So another difference is the scope. Generally, for financial accounting, reports are prepared for the company as a whole. So on a quarterly, monthly, annual basis, primarily quarterly and annually. Whereas managerial accounting, detailed reports are prepared not only for the company as a whole, but also for segments of the company, like different products, different departments, different geographic territories. And sometimes these reports are prepared on a daily or weekly basis. In order to manage a company, you need current information. So reports are prepared much more frequently for managerial accounting than it is for financial accounting. Okay, so let's look at the differences between the different types of companies: service, merchandising, manufacturing. So a service company basically doesn't sell a physical product, but it sells skills, knowledge, it sells time. Okay, they sell things that aren't necessarily tangible. You can't see, touch. It's a service. It's a use of time. It's, you know, use of skill. They're selling their knowledge, that kind of thing. Merchandising companies, they sell products that they buy from somebody else. So merchandising companies are like a middleman. They buy from manufacturers or wholesalers and then turn around and resell those products to consumers, to the public. Manufacturing companies, on the other hand, they make products. So they convert raw materials into finished products by using labor, equipment, facilities to make a product. As you can see, the largest expense for a service company, because they're selling services, their largest expense are salaries and wages. Okay, they're selling people's knowledge, employees' knowledge, experience, that kind of a thing, skills. Merchandising companies, their largest expense is cost of goods sold. You can think of cost of goods sold as the cost of purchasing inventory, stuff they're going to sell, and then turn around and reselling it. So the cost of buying the material or the goods that they're going to sell, that's usually the largest expense for a merchandising company. For a manufacturing company, this actually should say cost of goods manufactured. That's the cost of making the product that they're going to sell. Okay. So in my opinion, this is wrong. It should say cost of goods manufactured. That's a specific terminology for manufacturing companies. Looking at the types of inventory that the three different types of companies have. Service companies aren't selling any physical inventory. They're selling time or skills or knowledge, so there's nothing physical to sell, so there is no inventory. Merchandising companies, they sell merchandise inventory. That's the stuff that they buy that they're going to turn around and just resell with very little alteration of it. And then manufacturing companies, there's three different types of inventories: raw materials, work in process, and finished goods. Raw materials are materials on hand that are going to be used in the manufacturing process, but it hasn't been used yet. So it's sitting in a warehouse or something ready to be put into the production process. Work in process inventory, is inventory, is stuff that has been started but hasn't yet been completed at the end of the period. So they're still working on it. Finished goods inventory are items that they finished totally and ready, it's ready to be sold. The ways that we keep track of costs in the different companies. For service companies, costs are kept track of by period. So for example, we've spent this much on salaries for this month, for example. Okay, there's no product necessarily to allocate or keep track of costs by. So it's generally for services, and we'll see some exceptions throughout the course, but service companies keep track of most of its costs by periods. Merchandising and manufacturing companies keep track of their costs, a lot of their costs by product. So how much are the costs that go into a product? Since both merchandising and manufacturing companies are involved with physical products, we keep track of costs by, for merchandising company, for example, how much does it cost us to buy the products? So that's a product cost. We're keeping track of the cost by products. Manufacturing companies, they keep track of how much manufacturing processes costs go into the product. So how much of the labor goes directly into the product, how much materials go into a product, that's product cost. But they also have elements of period costs. Certain costs we can't trace directly into a product. And again, we'll see that in a subsequent chapter. So certain costs we just keep track of by period. So by month, how much did we spend on electricity, for example, for the month? So certain costs that can't be kept track of or traced directly to a product are kept track of as period costs. So period costs are expensed when incurred. So in other words, as soon as those kind of costs happen, you record it as an expense on your financial statements. Product costs, on the other hand, go into an account called inventory, which is an asset account, and then it's expensed when that inventory is sold. So it doesn't get expensed right away. It only gets expensed when the related inventory is sold. Okay. You can see the income statements for the three different types of companies: service company, merchandising, manufacturing. Notice that the merchandising company has inventory, merchandise inventory. That's the stuff they sell. Notice service companies don't have any inventory because they don't have stuff that they sell. Manufacturing companies have finished goods inventory in their financial statements, in their income statement. Finished goods inventory, again, are stuff that they're done with. Okay. Notice that raw materials inventory and work in process inventory, the two other kinds of inventories for a manufacturing company, don't enter into the income statement. It's just the beginning and ending finished goods inventory in the cost of goods sold calculation here. So you can see the cost of goods sold calculations. For a merchandiser, it's beginning merchandise inventory. So how much inventory did they have at the beginning of the month, plus any purchases of inventory that they made during the month and the related shipping costs. That gives the total of those two gives us cost of goods available for sale. And we subtract the ending merchandise inventory, inventory that is not sold yet at the end of the month. That gives us cost of goods sold. For a manufacturer, beginning finished goods inventory, so how much completed goods did they have on hand at the beginning of the period, plus cost of goods manufactured, how much did it cost them to make the product, and we'll see that subsequently, the calculation of that. That gives us cost of goods available for sale, similar to the merchandiser, and then subtract ending finished goods inventory, so inventory that has not yet been sold, that is complete. That gives us cost of goods sold. So similar calculations for the two with just little differences. Okay, balance sheet. Notice with respect to inventory, service companies don't have any inventory. Merchandising companies only have one type of inventory, that's merchandise inventory. Again, inventory that they bought that is going to be sold. And manufacturing companies have three different kinds of inventory: raw materials inventory, work in process inventory, and finished goods inventory. Okay, now that we've looked at the three different kinds of companies, service, merchandising, manufacturing, let's now look at how do we keep track of costs for these different kinds of companies. So there's two categories of costs: direct and indirect. Direct costs are costs that can easily be traced to a cost objective, so to a product usually. So we know how much of the cost goes into the product and we can keep track of that effectively. So that's a direct cost. An indirect cost is a cost that we can't directly trace to a product or a whatever the cost objective is. How cost objective means how we're keeping track of cost. Okay, again, it's usually by product, but sometimes it's by department. Okay, and we'll see that later on in the course. Okay, so again, direct, easily traced to a cost objective. Indirect can't easily be traced. Example would be, let's say a spam musubi maker. The spam, the cost of the spam in a spam musubi, well, we can figure out that cost fairly effectively. So that's a direct cost. On the other hand, the electricity used to make one spam musubi, we can't trace that very effectively. It's not easy. We can't directly say, oh, this spam musubi used 10 cents worth of electricity, for example. That's an indirect cost because that cost cannot be effectively traced to the product. Okay, and well, we'll see later how we handle those. Three different kinds of product costs. So costs that go into a product. Direct materials. So direct materials are materials that we can trace that go directly into the product. Direct labor. This is the labor costs that go directly into the product. So these are the workers who handle or make a product. So we know exactly how much cost for labor goes into a product. Manufacturing overhead, on the other hand, are costs related to the making of the product, but can't be directly traced to the product. So those are the indirect costs. So any cost that has to do with making the product that we can't, or it's too small to worry about and don't want to trace it directly to the product. So examples of indirect materials would be the, let's say, the oil used to cook the spam in a spam musubi, okay? It's indirect because it's too small to really worry about, although it could be considered direct materials if you wanted to try to figure out exactly how much oil is used to fry one spam in a spam musubi. But if it's not cost effective to do that, in other words, it costs too much to figure that out, we'll put it into indirect materials. Okay. Indirect labor is the workers who don't directly work with the product, but have something to do with the process of making the product. So the janitor in the plant who cleans the plant, that's a process that's involved indirectly with the making of the product, because you need to have clean machines and a clean plant to make your product. Okay, but the janitor's time cannot be traced directly to the product, so it's indirect. Okay, so again, 3 different kinds of products in a manufacturing process: direct materials, direct labor, and manufacturing overhead. Here's a chart that lists different kinds of costs and whether those costs are period costs or product costs. You can generally think of product costs as direct materials, direct labor, manufacturing overhead. So all the costs associated with making of the product. Okay, those are product costs. Period costs are overhead costs for selling and administrative. So like the president's salary. The president is not directly involved with the process of making the product, so that cost wouldn't go into the product cost. That's a period cost. So we're not directly seeing how much of the president's salary goes into a product. So we track that as monthly, annual cost. Similarly, advertising. Advertising is not an expense involved with making of a product. Advertising is selling the product once it's already done. So that's a selling cost. That's why it's a period cost. Okay. Again, you'll see all the different kinds of costs, and I believe this is in your textbook as well. Here's some terminology. Prime and conversion costs. Prime costs are defined as direct materials plus direct labor. Okay. Conversion costs are defined as direct labor plus manufacturing overhead. So notice there's an overlap here. Direct labor is an element of both prime costs and conversion costs. And we'll look at these terms in subsequent chapters of this textbook. Okay, next we're going to look at preparing an income statement and a statement or a schedule of cost of goods manufactured for a manufacturing company. This is hard to see, but here's an example of a income statement for a manufacturing company. And again, this is in your textbook. We're using this Smart Touch Learning as a sample company that we're going to be using throughout this chapter. Okay, so again, the format of an income statement for manufacturing company is important because remember the cost of goods sold calculation here was beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory gives us cost of goods sold. Okay, so how did we get this cost of goods manufactured? Well, first let's look at the flow of product costs in a manufacturing process. So the materials that we purchase and the related shipping goes into this account called raw materials inventory. So then once the item is put into process, then direct labor and manufacturing overhead is added to the work in process inventory. So again, work in process inventory is stuff we're working on now. It's not done yet. And then once it's finished processing, then it moves to finished goods inventory. Okay, so again, costs are accumulated. The purchases of the raw materials is accumulated in raw materials inventory. Then when we add direct labor and manufacturing overhead, when we start working on the product, that is put into work in process inventory, along with the costs that were previously in raw materials inventory, because that gets moved to work in process. And then when the product is finished being manufactured, all the costs that were in work in process inventory get transferred to finished goods inventory. Okay, so these are product costs. Again, product costs were raw materials inventory, work in process inventory, and finished goods inventory. And as you can see, those are all balance sheet items. All inventory items are assets. When the sales occur, that's when the inventory costs are transferred to cost of goods sold. But again, as we saw in an earlier slide, we don't make the transfer of the costs from finished goods inventory into cost of goods sold until the items are sold. And notice the cost of goods sold is an income statement item. So it gets transferred from finished goods inventory, which was a balance sheet item, into the income statement in the account cost of goods sold, which is an expense account. Okay. So on the income statement, you'll see that sales revenues minus cost of goods sold equals gross profit. Then you subtract the selling administrative expenses to get operating income. Okay, so the selling and administrative expenses, as we saw in a chart earlier, are period costs, those costs that we keep track of by period, so by month, by quarter, by year. Cost of goods sold, again, because it involves these three costs that I'll go into cost of goods sold, those are product costs. Okay, so here's that schedule of cost of goods manufactured. And don't forget that the bottom line here, cost of goods manufactured, that amount goes into the calculation of cost of goods sold. So the schedule of cost of goods manufactured, the formatting is very important. So you start off with the beginning work in process inventory. So the cost of the items that were being worked on but aren't finished yet. So whatever you ended the previous year with, since this is an annual schedule, whatever you started the year with, so whatever you ended the previous year with is the same as what you start this year with. So that's the first line. Then you add the direct materials used, and you need to calculate the amount of direct materials used by taking the beginning raw materials inventory, adding the purchases of raw materials, including the freight, subtracting ending raw materials inventory. That gives us direct materials used. Okay. Then we add direct labor. Generally, the direct labor is given to you as a single amount. And then we add the third component of manufacturing costs, manufacturing overhead. So that's the indirect materials, indirect labor, depreciation, plant utilities, insurance, property taxes. Again, all the costs associated with manufacturing a product that can't be traced directly into the product. Those are the manufacturing overhead costs. Okay, so you add the total manufacturing overhead, the direct labor, and the direct materials used. That total is total manufacturing costs incurred during the year. So in our case, the 607. Again, that's the sum of direct materials used, direct labor, plus total manufacturing overhead. Okay, so we add the total manufacturing costs incurred during the year. to the beginning work in process inventory, and that's the total manufacturing cost to account for. From that number, we subtract the ending work in process inventory to get cost of goods manufactured. Okay, so the schedule of cost of goods manufactured, what's important about the schedule is the format. Okay, this is a standard set format. Okay, this format shouldn't be changed at all. Okay, so just use this format when you are computing the cost of goods manufactured. Okay, so as a summary of that schedule of cost of goods manufactured, basically you take your beginning work in process inventory, you add your direct materials used, you add your direct labor, and you add your manufacturing overhead, then you subtract it ending work in process inventory, and that gives you the cost of goods manufactured. Okay, and this is just kind of reiterates one of the earlier slides that we saw. Notice that the raw materials inventory is the beginning inventory plus your purchases minus your ending inventory. That gives you direct materials used, and you saw this section here in the statement of cost of goods manufactured. The direct materials go into the work in process inventory account here. So we take the beginning inventory of work in process, we added direct materials, direct labor, manufacturing overhead, we subtracted ending inventory to get cost of goods manufactured, and that was the structure of the previous slide. That cost of goods manufactured goes into the finished goods inventory calculation, where you take the cost of goods manufactured, you add the beginning finished goods inventory, and subtract the ending finished goods inventory to get cost of goods sold. Okay, so this is kind of a summary of all the different, the flow of the costs through all the three different inventory accounts. As far as unit product cost, so we know how much it costs in total, that's cost of goods manufactured. So what's the per unit cost? Well, it's simply dividing the cost of goods manufactured by the number of units, and that gives us our unit product cost. So for example, if the cost of goods manufactured is $800,000 for a company and they made 25,000 units, what's the unit per unit product cost? It's simply the 800,000 divided by the 25,000, or $32 per unit. That's how much it costs to make the product. Okay. So the number of units sold times the unit product cost that we just saw equals the cost of goods sold. Okay. So again, in our example, let's say the manufacturing cost was that $32 that we came up with. If 20,000 units were sold, the cost of goods sold would be 32 times 20,000, or $640,000. Oops, before we get to the next section. The difference between cost of goods manufactured and cost of goods sold is that cost of goods manufactured is how much did it cost us to make the product. Cost of goods sold is what was the cost of those items that we sold. If the number of items that we made and the number of items we sold are the same, so in other words, if we sold everything that we made, the cost of goods manufactured would equal the cost of goods sold. Okay, but it's going to be different if we didn't sell all of the items that we made. Then there will be a difference between cost of goods manufactured and cost of goods sold. Okay, so learning objective 5 has to do with service companies and merchandising companies. Okay, so service company, the cost per service. So remember, it's not per item because we don't have products that we have to keep track of on a per unit basis. So we keep track of our costs by the number of services provided. So that could be like each customer, okay, or each project. So for example, if a service company's total costs are $24,000 and we perform 3,000 services, what's the unit cost per service? Well, simply the 24,000 divided by 3,000 services, so $8 a service. Why is it so important that we know how much it costs us to provide a service? Well, that will help us in determining how much we need to sell our services for. If it costs us $8 to perform the service, then we better charge more than $8 if we want to make a profit. For a merchandising company, same kind of thing. The total cost of goods sold divided by the number of units sold. So if a merchandising company's cost of goods sold was $500,000, and if they sold 20,000 items, what's the average cost? Again, the cost of goods sold, 500,000 divided by the 20,000 units or items. The average cost is $25 each. Again, it's important to know what the per unit cost is so that we can appropriately price what it is that we're selling. Yeah, so if it costs us $25 on the average, then we better sell it for more than the 25. Okay, that's chapter 16. Until next time, aloha.